Well, I think that we're heading into a little bit of a cycle, which is why I think that credit and distressed credit are going to be very, very topical, not only in the very near future, but in fact for years to come. I think that we're very used to a V-shaped type of price action where we see very significant sell-offs, which are very quickly corrected by central banks and governments really coming to the market's rescue. I think what we're experiencing this time is slightly different. I think that we're likely to see a cycle which is more prolonged and more typical. And listen, I think it's going to be interesting because I think there are a lot of market participants that haven't really experienced that, considering the fact that it isn't since GFC that we have seen this type of price action lasting for that long.
Yeah, definitely a new regime, and we talk about it a lot with guests on the show and fund managers like yourself. One thing that I think is interesting in credit is you have seen a significant spread widening, and the spreads, I guess you could say, reached their wides towards the end of September. But that wasn't accompanied with a huge increase in the rate of defaults. Or, you talk about a lot of distress in the system, but it actually hasn't really materialized. Why do you think that's the case?
Well, I personally think that actually default rates are most probably the most backward-looking measure when it comes to distress, and I think that people's focus on distress rates is really misplaced. By the time you see distress rates really going up and you see default rates going up, chances are we're on our way out as opposed to on our way in. So historically, if you look, price action obviously always precedes defaults. Simplistically speaking, whether that's private equity, whether that is public equity, an owner of a company will do everything and anything possible before they hand over the keys to lenders. You're going to see a lot of rescue financing. You're going to see a lot of companies, most probably getting supported by their sponsors. And it is only when all other options are explored that you actually see defaults, that you actually see hard restructurings. So I think that default rates as a measure of distress is a very, very tricky thing. I think that, again, over the long term, that's something that, can tell you, hey, just how big was this? But it is very retrospective.
So where are some of the places right now that the signals are flashing red?
Oh, well, I think signals are flashing red all along, all around.
All right, so short bias then.
Well, I wouldn't say that it's short bias. I actually think that there are a lot of interesting opportunities on the long side as well. It is actually really fascinating what has happened in terms of price action over the past 3 to 6 months. What you expect to see in an environment such as this is a decent amount of decompression in terms of companies' performance. Companies with bad balance sheets, companies that are cyclical, companies which are burning cash are supposed to go lower, and companies which are actually, in a good shape, cash flow generating, have lower leverage, are supposed to hang in there. Instead, what has happened is some of those bad companies haven't really been sold off so much because there's so little liquidity in the system that people know if they try to sell some of those credits, they'll simply push prices down 30, 40 points, and they're still not going to be able to sell risk. So instead, what people are doing, people are selling their winners. And as a function of that, you actually see a number of situations which I would argue are performing situations, trading to 12% unlevered yield, which is very exciting when you're creating risk at 50% LTV, 2x covered through the cycle. Again, for a distressed investor, there is nothing more exciting than buying non-distressed assets at distressed prices.
Sounds like it. And
so,
how